In this video, I'd like to talk about market value and book value, and I want to show you some of the problems that we have with financial statements because they report book values and they are not really useful for financial managers for making decisions. Indeed, financial statements show assets at their historical costs. So assets are reported on the books at the price that the company paid for them. So it doesn't matter how long ago they were purchased. For example, the value of a building that a company bought 30 years ago at the price of 50,000 ringgit in KL, maybe today is 1 million ringgit. But in the book value, in the financial statements, it is still reported as 50,000 ringgit. Its book value, right? Its historical price. So is it really useful if today a manager wants to use this information? I really don't think so. For current assets and current liabilities, market value and book value can be similar because current assets, as you remember, can be converted into cash over a short period of time. So we expect less issue for current assets. But for different types of the other types of assets like long-term debts or equity or fixed assets. For example, as I said, the property that you bought for the company 50 years ago, this can be a big problem. Indeed, assets are listed at historical costs, less accumulated depreciation. So, and depreciation is something that accountant use. Actually, it's not a real thing. So this is another problem for financial managers to use these figures and these reports. So the balance sheet also does not include the value of many important assets, like, for example, human capital. So the total assets that you can find in the balance sheet is generally not a very good estimate of what the assets of the firm actually worth. For example, a railroad might own a lot of lands purchased a century ago. So they may have bought them very cheap 100 years ago, but in the financial statements, still the price that have been reported for the value of those lands is the price they paid 100 years ago. So the balance sheet shows actually the historical cost, which is not really useful if you want to make a financial decision today. The same is for the liabilities. For the liabilities, for example, balance sheet report its face value, but actually when interest rates changes or the risk of the firm that issued them changes, risk of your company that borrowed money changes, the value of these loans or liabilities will change in the market. But in balance sheet or in financial statements, it is still the historical value, the face value of the loan. So again, this is not really useful for financial managers who want to make a decision today. So indeed, balance sheet does not reflect its current market value, which is the most important thing for decision making. Equity is the ownership interest in the firm, and the market value of equity, if you want to compute the market value of equity of a firm, you just need to multiply number of shares and today's share price. And how the share price is determined is usually in the market, through supply and demand, and what impacts actually the future growth of the company. It means if investors believe that in the future the company will grow, then they will pay more for the shares, for the stock. So the price of the shares may change every day, actually even every hour, even sometimes every minute. But what is reported as the shareholders' equity in balance sheet is just the historical cost. So it doesn't show the price changes. So again, it's not really useful for decision making, financial decision making. But which one is more important? As I said, market value. Book value is not really useful for financial decision making. Market value are generally more important because they are more reflective of the cash flows that would occur today. So they show the value, the today's value, and you want to make a decision today. So you don't care what happened 50 years ago, right? And managers and investors will be more interested in the market value of the firm rather than its book value. And this information is not, unfortunately, reported on the balance sheet. The fact that balance sheet assets are listed at cost means that there is no necessary connection between the total assets shown and the market value of the firm. And indeed, many of the most valuable assets that a firm might have, like good management, a good reputation, and talented employees, also do not appear on the balance sheet. And this is another problem of using balance sheet for financial decision making. To give one example, okay, let's consider Coca-Cola. The brand of Coca-Cola, actually, I checked, and the value of this company and the brand name is value. The value is more than 50 billion US dollar. More than 50 billion US dollar. Many well-known companies are the same, like Microsoft, like Google, like Alibaba, but when you check their balance sheet, do you see this information? No. So for financial managers, the accounting value of the equity is not really important. They are interested in the market values. So whenever we speak the value of an asset of a company or the value of the firm, we usually mean its market value. When we say value, means market value. We are not talking about book value of the firm, which has been reported in the balance sheets. For example, when we say that the goal of financial manager, you remember we discussed this in previous topic, that the goal of a financial manager is to increase the value of its stock. We mean the market value of the stock. We are not talking about the book value.